Hello and welcome to this session. This is Professor Farhat, in which we will discuss performance materiality, also known as tolerable misstatement. In the prior session, we looked at materiality, but for the financial statement as a whole, and we also called it preliminary judgment about materiality. And this is the first step in setting materiality. So an auditor will have to determine the overall materiality, which is the materiality for the financial statement as a whole initially. And let's, for the sake of illustration, we say that figure is 40,000. Now, in the prior session, we looked on how we computed that figure, whether it's a percentage of total assets, percentage of revenue, percentage of earnings before taxes, or some other figure. This level, this 40,000, represent the maximum amount by which the financial statements as a whole can be misstated before they are considered misleading. So 40,000 is that statement that for the whole financial statement, as long as the error is 40,000 individually or in aggregate, then we could live with it. Less than 40,000 for the whole financial statement. Great. In this session, we're going to set what we called the performance materiality. And this is step 2. Step 1 is you set up what's the overall materiality for the whole financial statement. Then we have to do what? Set performance materiality. What is performance materiality? Simply put, performance materiality is taking the materiality for the financial statement as a whole and allocating it to various segments. Why? Well, you really don't audit the financial statement as one unit. You don't audit the financial statement as one thing. When you audit the financial statements, and you're going to see this later, and if not, I'm just going to tell you now, you are going to break down the financial statement into various segments or various buckets. For example, cash, account receivable, inventory. And what's going to happen, you're going to take this 40,000 and allocate part of the 40,000 to the various segments. Now, when you audit account receivable, then you're auditing sales. You're auditing sales returns and allowances. You're auditing sales discount. Why? Because account receivable is related to those accounts. You are auditing bad debt expense. You are auditing allowance for doubtful account. Because of the interrelationship between accounts, you start with a balance sheet account. Then from that balance sheet account, you will touch upon other accounts. So performance materiality is the amount of misstatement an auditor is willing to accept and conclude that the account itself, because we're going to be allocating the 40,000 to various accounts, that account by itself, how much it can be misstated. Now, because we don't audit the financial statement as one unit. Now, also you need to know that, as I mentioned earlier, performance materiality, this is the language that the CPA, the International Auditing Standard, uses, also known as tolerable misstatement, and the PCAOB uses that term. I really like tolerable misstatement, a better term. Nevertheless, you have to be familiar with those. So in this session, we'll focus specifically on performance materiality. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So to illustrate performance materiality, we're going to be using a simplified example. And looking at this company, we have cash of 450,000, account receivable of 550, inventory of 1 million, total of 2 million. We have zero liabilities, 300,000 in retained earnings, 1.7 million in common stock, total liabilities and equity of 2 million. We're going to set the materiality for the whole financial statement or the financial statement as a whole at 40,000, which is 2% of total assets. This is what? This is the materiality for the whole financial statements. And for the sake of this example, we're going to be auditing cash, account receivable, inventory, and common stock. Retained earning is the cumulative amount, was already audited from the prior year. Therefore, we need to focus on the other 4 accounts. Excellent. the question becomes how to allocate this $40,000. Remember, the performance materiality is when you allocate this $40,000 and we identified 4 accounts we are going to be auditing. So how much are we going to be allocating? Well, let's start simplifying things, and we're going to say we're going to allocate it equally between all 4 accounts. Now just follow with me. What does it mean if we allocate it equally? What am I saying if I allocate the $40,000 equally? It means I allocate $10,000 to cash, $10,000 to account receivable, $10,000 to inventory. It means I can accept cash to be misstated by $10,000. So if I'm looking at the cash account, I audit the cash account, and I can accept a misstatement of $10,000 and still consider the account fairly stated. Same thing with account receivable, same thing with inventory, same thing with common stock. What do you think? Do you think this is a good idea? And the answer is not. It's not even reasonable. Why not? Because not all accounts are the same. What does that mean? For example, cash is not the same as common stock. Cash is not the same of account receivable in terms of importance, in terms of the number of transactions, in terms of inherent risk. There are many. Each account is different. Therefore, you cannot just take this materiality and spread it equally. This is called risk of uniform materiality. It means you're assuming all accounts are the same. Let's talk about cash, specifically cash. Now, you may not be familiar on how to audit cash. I'm going to give you some information. Cash is fairly an easy account to audit. Why it's easy? Again, don't worry, just accept this for now, because you can ask for external evidence from the bank. You can get a cash confirmation. The cash transactions are processed through a third party. The checks are processed through a bank. So it's an easy way in a sense that you can obtain the information easily. That's one. 2, the third party is reliable. The bank information is reliable, and it doesn't cost much to audit cash. So when it comes to cash, it's easy to audit, cost efficient to audit. So why allocate 1/4 or $10,000 to cash of the materiality if there's an easy way to basically audit everything and practically accept almost zero error? Why allocate? Why accept $10,000? There is no reason to do that. Therefore, we're going to allocate for now, just say less to cash. How much less? We're going to kind of throw some numbers around later. So cash is easy and cost efficient to audit. Same thing with common stock. We have 1.7 million in common stock. Let's assume those common stocks were issued this year. It's easy to determine whether that 1.7 million is a true number. How? I can look at the board of directors meeting. When do we issue stocks? The board of directors, they decide, or there's a major announcement at the company. I can easily, and cost efficiently audit common stock. Also, the more important the account is, which is cash is important, common stock is important, the more I have to lower my performance materiality. Why? Because I cannot tolerate mistakes. I cannot tolerate $10,000 in cash, a misstatement in cash that much for a $450,000. That's a large amount. $10,000 in cash, it's a lot of money, especially relative to $450, let alone $10,000. We cannot have we cannot accept $10,000 of cash missing. Therefore, of the $40,000, I'm going to allocate maybe to cash. Maybe I'm willing to, $500. It should be zero, but the point is, let's assume $500. And for common stock, I can tolerate, let's say, $1,000. Okay. Yes, I might have made a mistake for $1,000 in common stock, but in the grand scheme of things, 1,000 of 1.7 million, it's acceptable. It should be zero, but I'm willing to tolerate that much. If I didn't find anything, I'm going to assume it's misstated by 1,000. Very low amount. But the more important the account is, and the easier to audit in a cost-efficient way, the lower I set my performance materiality. Now, how about inventory and account receivable? So let's assume I allocated 1,000 for cash, just to keep it simple, 1,000 to common stock. So I'm left with 38,000. How am I going to allocate the 38,000? I still have account receivable and inventory. Well, how am I going to allocate this? Well, in any way I see fit. But let's talk about account receivable. What's the problem with account receivable? Not the problem, but what is the nature of account receivable? Account receivable is composed, could be of many customers, maybe thousands of customers. and maybe tens of thousands of transactions. It's heavy activity transaction, selling to customers on account, receiving money, then having dispute, having bad debt expense. It's an account that's involving a lot of work. And I'm going to be sampling. Sampling means I cannot audit everything, so I have to select some numbers. I'm going to allocate from my misstatement. I'm going to allocate maybe, let's say, 30. I'm going to allocate 30,000. I'm going to allocate 30,000. My performance materiality is 30,000. So remember, I still have 38. I allocated 30,000. What does that mean? It means an account receivable, I'm willing to assume a $30,000 misstatement in my account. Why? Because sometimes I sell on credit, the customers don't pay, or there's a dispute, I have an account receivable, it's on my books, part of this 550, the customer disagrees, so it's not really an account receivable, it's an error, the customer is not sending their payment, they have an account receivable, it's not really legitimate because really it should be written off. So the point is there's mistakes, and I'm willing to accept $30,000 of performance materiality, or I'm allocating to account receivable 30,000. What does that mean? It means I will accept this account as long as there is up to $30,000 of misstatement. Now, why 30,000? Well, why not 40? Why not the remaining 38,000? The lower I set my performance materiality, the more likely I'm going to catch those mistakes, because anything above 30,000 is material. So I'm going to try to catch every mistake below 30,000 and fix it, because I don't want those small mistakes to add up. So I'm going to allocate 30,000 to account receivable. Great. Now, we allocated 30,000 to account receivable. What's less is 8,000. 8,000 to inventory. Inventory, same concept. When I buy inventory, I have a dispute with the customers. The inventory is not good. I don't record it as inventory because I have to return it. It's not of good quality. My inventory is all over the place, so I expect some mistakes to be in the inventory account. But I'm willing to tolerate the remaining 8,000. But the lower I put my performance materiality, 8,000, the more important is the account is. Inventory is an important account for me because there's $1 million worth of inventory. I have a lot of inventory. The inventory is important. I'm going to lower my materiality. It means I am going to tolerate less mistakes in inventory. So when I audit inventory, anything, I'm going to set it at 8,000, and anything below 8,000, it's going to be looked at closely and basically ask the client to do what? To fix it. But I'm willing to tolerate up to 8,000. So notice, so what we're saying, inventory is more important than account receivable, and inventory, maybe it's a more cost efficient to audit versus account receivable. I have a lower threshold. So what I did, I allocated 1,000 to cash, 30,000 to account receivable, 8,000 to inventory, and 1,000 to common stock. Now, how did I do this? At the end of the day, it's a professional judgment. But the key is, the more important the account is, the lower the threshold. Okay, so, and remember, let's assume we audited this whole financial statement. We audited the financial statement. We went through the audit. So that's another thing I want you to understand, which we'll talk about when we evaluate evidence. So let's assume I audited all 4 accounts, and I found, this is unrealistic, I found 0 misstatement based on the sampling, based on my audit procedures. Although I found 0 misstatement, I didn't find any misstatements. Everything was good, which is like, this is la la land, but I'm just keep going. I would still say there's a $40,000 of misstatement. We assume $40,000 of misstatement. Why? Because when I did this audit, I sampled account receivable, I sampled inventory. Cash, most likely I looked at everything in common stock, but for inventory and account receivable, I sample. Because I sample, I might have missed something. Therefore, when I allocate my performance materiality, it's going to be less than the materiality as a whole, because there are certain mistakes I am going to assume I did not catch, and they exist. So what happened is this: my actual mistakes or my actual misstatement were 0. Good. I have a buffer of 40,000. That's what I'm saying. Buffer of 40,000 means I did not find any mistakes. I'm still assuming there's a $40,000 of mistakes, but I can live with them. So this is the actual misstatement 0. Likely misstatement, and we'll talk about this later on in a separate recording, there's an actual misstatement happens to be 0, but the likely misstatement is 40,000, because I'm saying I am accepting a $40,000 error, still assuming the financial statements are fairly presented. So we need to tolerate less than 40,000 to make a buffer amount. And that's why we set performance materiality for each account lower than the materiality for the whole financial statement. The lower we set it up, the more important that account. So again, this is just a general theoretical idea. Let's dive a little bit more into this. So audit segmentation. When we audit the financial statement, I just told you, we look at each account separately, each cycle separately. We collect evidence by segment. For example, as I mentioned, account receivable will give us information about sales, will give us information about sales returns and allowances, will give us information about bad debt, will give us information about the allowance. So this is how we audit, and we allocate a number, a performance materiality for that account. Same thing with inventory. When we audit inventory, we're auditing purchase returns and allowances, purchase discounts, cost of goods sold, indirectly accounts payable. So we allocate a number to that. So certain accounts are expected to have more misstatement than others. And I just told you account receivable, inventory, because they have many transactions. So remember, not all account balances are the same. That's why we allocate different performance materiality. We'll look at an example again later. There's a risk of uniformity when you say, let's do it equally. No one does it. I'm reminding you what the risk is so you understand it. And to illustrate this concept one more time, for example, think of property, plant, and equipment. A company might purchase few property, plant, and equipment throughout the year. Maybe a building, few trucks, a vehicle, a machinery. It's easier for the audit to look at all these transactions, or maybe 5, 6, 7 transactions, versus because it's easier to look at this, we can set performance materiality low, and the accounts are important. Each transaction, each machinery, each building is a major account. So it's important, easy to audit, I set performance materiality low. Account receivable, I have a lot of transaction, and the amount may be smaller for each transaction. I'm willing to tolerate more. I would allocate more of the performance materiality to account receivable. Related party transaction, I tolerate none. I tolerate 0 because I want to look at them separately. So this segmentations, when we segment the audit, allows the auditor to focus on specific areas that are higher risk of material misstatement, because we separate the financial statement into separate cycles. And we're going to look at each cycle separately later on. Then performance materiality is set lower than the overall materiality, and the more important the account and the easier to audit, cost efficient, the lower the materiality. How low? The more important the account, the lower the materiality. The easier the account and the more cost effective it is, the lower the materiality. So what's the purpose of performance materiality? Let's kind of summarize everything. The main purpose of setting performance materiality is to reduce the probability that the sum of all misstatement reaches a level that could be material to the whole financial statement. When I set my performance materiality low, it means I want to catch all those small mistakes before they add up to be a major mistake for the overall financial statement. So when I set materiality low, I'm catching the low mistakes. This way, I'm catching the mistakes that could individually, small mistakes could add up to a lot, so I can catch them, fix them, so my statements are not misstated. My financial statements are truthful. Think of this analogy. Think of someone asks you to proofread a long essay. Well, what can you do? You can do two things. You may decide to focus on every paragraph, or you can decide to skim the whole financial statement. When you decide to focus on every paragraph, it means you are setting performance materiality. You're going to look at the introduction alone and just focus on that. Said, I am going to accept only one mistake in this paragraph, and one mistake in the first paragraph, and I will set one mistake for each paragraph. So this way, if I missed anything, I'm willing to tolerate one mistake. Then when I add them all up together, it's not a big deal. But if I skim over the whole essay, I may miss the details because I'm skimming over it. And as a result, because I'm skimming over it, there's going to be a lot of small mistakes. And when you put them all together in this essay, it's a major issue. So by doing so, by focusing on every paragraph, you are likely to catch more typos and mistakes early on, which prevent the accumulating and affecting the overall quality of the essay versus skimming. Same concept with performance materiality. Auditor aim to catch smaller errors in different parts of the financial statements before they combine, reduce the liability of they combine into a significant error that could lead to misleading financial statements. So during the audit, by setting performance materiality, it's going to help you determine what type of audit you're going to do, when are you going to do it, and how much of the audit you are going to perform. Again, materiality is important because the lower the materiality, the more work you have to do, because you want to tolerating no mistakes. Another illustrative example, again, to illustrate this concept. I know I keep giving you examples. It's important to understand it because many students find difficulty in this concept. Let's say we're talking about sales specifically, and we total sales of 10 million, and we allocated an overall materiality of $500,000. We say we can tolerate the overall materiality for this sales is 5%. It means we can tolerate up to $500,000 in mistakes and still believe sales is fairly stated. Well, now what we're going to do, we're not going to audit sales as a whole. We're going to take sales and break it down into 3 components. Well, we're going to look at sales from domestic market, international market, and online sales. And for each of these segments, we're going to allocate performance materiality of 2%. It means we're going to look at domestic sales, and we're going to try to catch any mistake. We're not going to have any mistakes above 200,000. Catch them all that are below 200,000. Why? Because we want to catch them. Same thing with the international sales and online sales. We'll set the performance materiality lows. This means any error found in these individual segments over 200 need to be examined and possibly corrected. Even though it's below the $500,000, but we cannot take the chance. We cannot say there are certain mistakes we're not going to catch. So we're going to have to catch anything above 200,000, although it's below materiality, but we want to set performance materiality lower so we can catch those mistakes. So this helps ensure that the total errors across all the segments don't add up and exceed the acceptable limit, which is $500,000. So that's why we want to catch those mistakes early on by having a materiality. So when we set performance materiality, we assume not all accounts are of equal importance. There's a risk of importance. The more important the account, the lower the threshold. For example, cash is important. Cash, we have set the cash flow materiality. The more important and the easier to audit, the more we do. And cash hit both. Notes payable, same concept. If you have loans are important, and we have to set low materiality for them because it's also easy to audit notes payable. You confirm notes payable with the lender. Related party transaction is another important account. If there's any related party transaction between the CEO and the company, we have to set materiality low because there shouldn't be a lot of transaction and they should be important. Therefore, we have to audit them. Significant acquisition also will be considered a transaction that's of a high importance. Therefore, we set low materiality for those. So there are certain transactions, and don't worry, we'll look at an example later to illustrate this. Also, when we are setting materiality, we have to take cost into account because we have to devote time, resources, and you have to provide the resources and tools to the team. So we have to allocate performance materiality properly. Audit can escalate with the amount of detailed checking and verification required. So we cannot spend time anywhere. We have to plan properly. Auditors need to balance the need for thoroughness with practical constraint of audit budget and timeliness. So we have to finish the work early within a budget. We don't have unlimited resources. So performance materiality will help manage costs because it will tell us where to focus on, what account you need to focus on. The more important we need to focus on, the more time, the more resources we need to allocate to this account. Now, the best way to illustrate again is to work a comprehensive example. I will do this in the next recording, but let's take a look at this multiple choice question to see if we understand performance materiality. What is the primary reason for setting performance materiality at a level lower than the overall materiality? So I'm telling you, performance materiality is set lower than the overall materiality. You need to know this. But the question is, what's the reason? Well, is it to increase the workload of the auditing team? Well, it might increase the overload on certain accounts if you set it lower, but is this the reason? Not necessarily the reason. You don't want to increase the overall load. That's not what performance materiality is about. But it does sometimes increase the workload, but that's not the reason for it. I would just take out A and I will wait until I look at B, C, and D. To ensure significant errors are identified and addressed. Yes, when you set performance materiality low, it means you're not tolerating mistakes. You have a lower threshold of tolerating mistakes. Yes, to ensure significant errors are identified and addressed. Between A and B, I will definitely cross A now, and I will keep B. To permit a higher of undetected misstatement. No, you are permitting lower of undetected misstatements. I would take out C as well because it's the opposite. To reduce the cost of the audit? No. Setting performance materiality lower or lower in general or lower than overall materiality may increase cost. But look, this is the work that we have to do. So it's not to reduce the cost of the audit. It's not to increase the workload. It's not to reduce the cost. It has nothing to do with this. It has to do with catching significant errors at a lower rate. This way they don't accumulate to a larger error, a significant error. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are an accounting student, a CPA candidate. Invest in yourself. Farhat Lectures is always here to help. Good luck and stay safe.